Okay, guys, I know you're missing me, so here is a little present from me to you, which is a lecture all about credit cards and taking out loans. Personally, I think this is kind of important information to know because many of you are going to take out credit cards in your life sometime. Some of you might even have credit cards now, and it's really important to know some of the basics so you don't get taken advantage of. Are you ready? Let's go! So first of all, what are some basics about credit cards? You didn't think I was going to have all the information on the screen and you could just ignore me, did you? Ha 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 ha. So here are some basics. What is a loan? A loan is borrowed money that must be paid back, usually within some sort of period of time. So when you're borrowing that money that must be paid back, it could be a year loan, it could be a 10-year loan, a 30-year loan, a 5-year loan, a 6-month loan. But regardless, loans are borrowed money that must be paid back. So if you are a borrower, you're borrowing the money, and the lender is lending that money. A lot of times the lender is going to be a financial intermediary like a bank, a credit union, or some other organization. In addition to that borrowed money that must be paid back, you're also paying back interest. So it's plus interest on the accrued monthly balance. And remember, interest is that fee that you pay for borrowing money. So when you're paying back your loan, you're also paying back even plus the interest each month. Loans, as I've said, are offered by banks and other financial intermediaries. So banks like Bank of America or Wells Fargo, they're offering loans, as are other financial intermediaries. So they're offered by banks and other financial intermediaries. And one important factor, and we're going to talk about this more when we talk about our credit score, but a super important factor is the better your financial standing, the better offers you'll receive. So the better one's financial standing, the better credit they have, the better history they have, etc., the better offers they're going to receive. Now, what is credit? Credit is giving money or something else of value in exchange for the promise of future repayment. So giving money or something else of value in exchange for the promise of future repayment. What does that mean exactly when you're giving money or something else of value in exchange for promise of future repayment? If I borrow something on credit, then I am promising that in the future I will pay it back. Now, this is obviously a risk that the bank or the financial intermediary or whomever is taking to loan me money or something else of value, even though I've promised to pay it back. But you know what? I could be a liar and I could say I'm going to pay it back, and I might not have any intention of doing so. So the banks and the other people, they have to protect themselves. And they protect themselves by looking at collateral. Collateral is a borrower's pledge of specific property promised to the lender. So that's the borrower's specific property that's promised to the lender. And what does that mean? That means that if I don't pay back my loan, if I borrowed a loan for 10 grand and I choose not to pay it back because I ran off to Mexico, then that lender, they get my house, my car, or anything else that I've promised to them as collateral. So it's that other property, that specific property that's promised to the lender if the borrower does not pay back their loan, etc. All right, moving on. So when lenders are looking at borrowers and they're deciding what they want to lend and for how much and how much interest they'll charge, etc., they are looking at the 3 C's. And the three C's even, they stand for your creditworthiness criteria. So what does that mean? The 3 C's for that creditworthiness, that's going to be your character, your capacity, and your capital. Now your character, just like your moral character, etc., that's your past record of paying bills. So that's your past record of paying bills. So that could be your rent, that could be your car loan, that could be your cell phone, that could be any bill. So that's on record of if you've been paying your bills on time. Next, your capacity, that's your level of income. So if you're making 50 grand a year, your capacity is 50 grand, I guess. So capacity is your level of income. And then finally, your capital, that's your income, your savings, investments, and other assets. So that's basically anything else. Capital and capacity kind of work together because capacity is being your level of income. And then capital, that's your income plus all the other stuff. So savings, investments, other assets. That's everything that can be counted up and given a financial number, a numerical amount. That's your capital. All right, moving on to types of credit. So there's two types of credit that we're really looking at. One is secure and the other is unsecure. Works out nicely that way. So what is secure credit? That's if you are purchasing a product and that product itself is the collateral. So secure credit is when the product purchased is collateral for the debt, which basically means if the debt is not paid, then the creditor gets to take possession of the item. So if I have secure credit, I buy a house, and then I do not pay back my debt, then the creditor gets to take possession of my house. Oh, neat. I'm not going to nominate my students for the NSLC because I don't know what that is. So again, secure product is product purchased for collateral for debt, and if the debt is not paid, then the creditor gets to take possession. That's not so great. You don't want that to happen. Now, the credit you're going to be more familiar with in your life more frequently is unsecured. Unsecured credit is based on the promise to repay the debt without committing savings or some other collateral as the guarantee. So it's based on the promise to repay the debt without committing collateral or savings or some other big ticket item. It's basically you're saying, look, I'm going to pay it back, but there's not entirely a guarantee, and if I don't pay it back, you can't repossess my house. Now, if you rack up so much unsecured debt, you've taken out 30 million credit cards, you've ruined your credit score, and you've done all this bad stuff, then eventually, the bank can take what's called a lien out, and they can do a lien on your house or any of your other assets. But you're going to avoid that because you're going to make good financial choices. So that's our secure and unsecure. Secure, the product is the collateral. Unsecure, there's not collateral. So if you don't pay it back, you're just a bad person. Just kidding, you're all good people. Oh, I miss you all. All right, so what's going on with the fine print? And this is one of the biggest things that I really want you guys to pay attention to, because this is where credit cards companies get you. Nonstop, they're hoping you're not gonna read the fine print because, it takes time and the print is really tiny. You have to put a lot of effort into it. So you are gonna make that effort because you are not gonna be taken advantage of. And when they try to, you're gonna say, nope, Ms. Dove taught me better. Not being taken advantage of today. Not today, credit card companies. Not today. Ha ha ha. All right, what is the fine print that you're paying attention to? Number one, the annual fee. A lot of times, credit card companies, etc., they're not going to charge you an annual fee for usage of the card, but other times they do. And it might be, like $50, $3, I don't know, some sort of fee that you pay every year. The next thing to pay attention to is the annual percentage rate. Oh, thanks, Laura Chalkley. I'll do that later. So your annual percentage rate, that's also known as the APR. That's the amount of interest charged per year. So the APR, annual percentage rate, the amount of interest charged per year. That makes sense. Annual, year, percentage, interest, rate, charged. So the amount of interest charged per year. APR can be either fixed or variable. If it's fixed, as it's non-surprisingly, fixed means that the APR stays the same. So if it's at 10% in January, it's at 10% in November. If it's at 15% in February, it's 15% in June. So fixed, it stays the same. Variable means that there's going to be some frequent changes of the interest based on the economy. And we'll get more into this next unit, but basically sometimes if the Federal Reserve, because remember they're in charge of how much money's in the economy, if they say we're going to raise interest rates, then banks also raise interest rates. So variable means that there's frequent changes based on the economy. If the economy is improving, then interest rates go up. If the economy is declining, interest rates go down. The next thing to pay attention to is the grace period. The grace period is the time between your billing due date and the date your payment is due. So this is kind of the period that you have to pay back your bills, to pay whatever you owe, and they're not going to charge you an additional fee. So the grace period is the time between your billing due date and the date that your payment is actually due, before they start charging a fee for you. The next thing to note is the minimum payment. That's the smallest amount you can pay to avoid charges. So if you take out a credit card and you rack up $500 on your credit card, your minimum payment might only be $20. So you need to pay at least that, because if you don't pay the $20, the minimum amount, the smallest amount you can pay, then they will give you a charge. On top of that, you owe, the $500 or whatever, you also are going to owe, have an additional fee. So you want to avoid that. That smallest amount you can pay to avoid charges. You definitely want to pay back, if you can't pay back in full, you want to at least pay back the minimum payment, the smallest amount, to avoid charges. The next thing to be aware of is your credit limit. That's the maximum amount you can charge. So the credit limit, the maximum amount that you can charge, which basically means if you get a credit card, your credit limit might be $500. That means you can spend $500, but if you see something really exciting for $600, you are not using your credit card to pay for it, because it's the maximum amount that you can charge on your card. Typically, when you start out, your credit limit's going to be really low. Then you're going to pay back. You're going to show that you have good credit worthiness, you have good character, etc., and your credit limit will increase as you get older and make good choices because you listen to your favorite economics teacher. All right, other fees. Obviously, if you're paying things back late, you get late fees. In addition, if you go over your credit limit, I'm being called, then you can also be charged for overspending. Hi, Lindsay, what's up? Yeah? Yes. Okay. Yeah. That sounds perfect. We are on board. All right. Talk to you soon. Bye. All right, sorry about that, that little interruption from Ms. Schlacks, but I'm going to keep on going by telling you a little bit about the incentives. So what are some incentives that the credit cards can offer you? Number one, cash back on your purchases. You spend X amount of dollars at, I don't know, Costco, because it's your favorite store, because it's amazing, and you get 2% of everything you spend cash back. So it's like it goes back into your account, which is pretty exciting. In addition, you can get discounts on air travel, you can get points for hotel, etc. It's pretty exciting stuff. So incentives like cash back and discounts. All right, and then finally, oh my gosh, you guys, we're already ending this amazing lecture. I know our time together is coming to a close, and it's so sad, but don't worry, there'll be more lectures in your future. So finally, what I want to leave you with, I want to leave you with some awareness of some dangers and some helpful hints. Because credit card companies, they are banking on you making bad choices. They're thinking to themselves, you guys are teenagers, you're already making questionable decisions in so many aspects of your lives, so you're probably going to make questionable decisions when it comes to credit cards as well, and they want to take advantage of you. So, but you are going to know better because you have been taught by your amazing favorite teacher, Ms. Dove. So number one, only buy what you can afford. I know it's going to be tempting because you're going to get a credit card and it's going to say you have a credit limit of $500 and you're working some minimum wage job and you really only have $100 of fun spending money, but now you have this credit card where it's $500 and you'll be like, oh my gosh, I'm gonna buy the tickets to that awesome music concert, and then I'm gonna buy these really cool shoes, and then I'm gonna go back and buy my favorite teacher so much chocolate, and it's gonna be so great because I have $500 free dollars. And then when you get to payments, you are not able to do the ideal, which is ideally you want to pay off the full balance at the end of each month. And that's because you're getting charged interest on whatever your balance is. So if you spend $500 on your credit card and your interest is 10%, you're now going to have to pay back $500 plus the 10%. But if you pay back your balance in full, and make your balance zero by the end of the month, then 10% of zero is zero. Win-win. You're not giving them any extra money. But this is one of the main ways that financial intermediaries, credit card companies, banks, etc., make profit off of people, that they charge them on interest on their accounts. So you're only buying what you can afford, because ideally you're paying off your full balance at the end of each month. If you are unable to do so, if you can't pay back the full balance, you need to pay at least the minimum balance so you can avoid paying fees on top of that, because you're already going to have to pay interest. You don't want to give them any more money. My number third most important factor or most important hit is to read the fine print. Don't let them get away with doing sneaky things, because a lot of times what they'll do is they'll say, all right, APR 2%. And you're like, oh my gosh, that sounds amazing. And then the fine print says APR 2% for the first 6 months. And then in the second 6 months, for the rest of the year, APR is 20%. And you signed it, so when you go to complain and say, I didn't know, they're gonna pull up your signature and say, you signed this, so you said you knew. That is a shady way that they make money off of you, but you're not gonna let that happen. Number 4, you're gonna build your credit, because this is part of your credit history. This is part of your character, so you wanna build your credit. And one of the things that you can do is actually you can open a card now. You could go, mom, dad, parent, guardian, can I open up a credit card? I don't want to use it very much, because you're going to use it very sparingly, almost never. You're going to use it, you're going to go down, you're going to buy something for $10, you're going to immediately pay off your balance, and then maybe 4 months from now, you'll do that again. And this builds your credit. So then when you're older and you really need good credit because you have to make a big purchase like getting a house or buying a car or financing your favorite teacher's worldwide trip all around the globe, you're gonna have way better credit. So you can start building your credit today. You can even open a credit card, and you can have your parents co-sign. It can be a joint account. So that's another way, because I know your parents are going to be like, I don't know if I trust you. And you're going to be like, my teacher told me to do this. Don't go home and say that Ms. Dove told you that you have to open up a credit card. But you can start building your credit now. And then finally, number 1 thing is know that credit card companies are targeting you guys. They are expecting you not to read the fine print. They're expecting you to buy way more than you can afford. I recommend, honestly, like, you've started out, you have your bank accounts, etc. If you have $100 in your bank account, buy it on credit card and then immediately pay it off from your bank account, because now you're using your card and you're paying it back. So you get that zero balance and not having to be charged any interest, because you know that credit card companies are targeting you guys, and you're not going to let them take advantage of you. You're not going to let them get away with that stuff, because you have taken excellent notes on loans and credit cards, and you are sadly now done with your notes. But don't worry, like I said, there'll be more notes in the future. So I hope you enjoyed this time. I hope to see you all have an amazing time at the rally. For those of you in first and third period, you're looking forward to it. In sixth period, you're reflecting while you stay in class sixth period, and you're reflecting on the great time that you had. I hope you all have a wonderful and amazing weekend. Get lots of rest, go outside, go enjoy nature, read a book for fun, talk to people face to face, try it out, you might like it. And I will see you all on Monday when we talk more about credit cards and more about personal finance. You're done, you made it, the end.